It's not the deal that you don't get that kills you. It's the deal that you do get that you shouldn't have got that will kill you. Is now a bad time to invest in multifamily real estate? We've seen all the headlines. Interest rates are way up. We've seen the fastest rising interest rates in the last 40 years. The volume of sales transactions are way down. Inflation, although it's starting to come down a little bit, still is very high at over 6%. This is way above the 2% benchmark that the feds are trying to achieve. The feds have even announced several more rounds of interest rates hikes, and Jerome Powell, the chairman, has said, expect more pain. So will that even be the peak of interest rates hike, or are there more to come? Who nobody knows for sure. Housing market has been on fire the last 9 months. Now that's starting to come down. The stock market is down. Cryptocurrency went from $2 trillion of value market capitalization to under $1 trillion. Do you know how many crypto millionaires work at McDonald's now? It's late in the market cycle. This is a bad time to invest, I've heard people say. A lot of lenders have disappeared from multifamily real estate. Bridge debt has all but dried up, and anything that does remain is prohibitively expensive. Sellers refuse to sell at today's prices because there's that psychological component of, hey, 8 months ago at a 3% cap rate, I was getting millions of dollars more in my sales offers. Now all of a sudden the offers and demand for my apartment building has gone down, and the prices that people are willing to pay has gone down. So sellers are refusing to sell. Buyers have disappeared because nobody's lending. There's rising interest rates, and there's huge amounts of economic uncertainty. So the sky is falling, everything's going down, the economy is filled with bleak predictions and uncertainty. This is certainly a time for us to stop investing, at least take a step back, and let's see what happens before we just keep on investing. Well, I challenge that. Let's take a look at that. In today's video, let's cut through the noise and get down to the fundamentals and see if we can make light of this and make sense of this and what we should do as investors to capitalize from it. If you haven't got this already, I have a free guide. It has the 5 criteria that all financial plans should have, and it's right there on the link below for free download. Welcome back to the channel. I'm Dr. Jonny Walker. I'm a successful endodontist as well as a self-made multimillionaire in real estate investing. All right, guys, enough. I'm the principal and founder of Walk of Wealth, which is not only a YouTube channel and a website designed to educate doctors, dentists, and busy professionals on how they too can achieve financial freedom through real estate investing, but we are also an investment firm that offers these very opportunities as well. We have invested in over 690 apartment units, valued at over $94 million of real estate transactional volume. And this is all in the last 4 years. What I'm more proud about is that I've helped so many doctors in beginning their path to financial freedom. I'm also excited to announce that we will be going live every Tuesday right here on this YouTube channel. 7 p.m. Eastern, 4 p.m. Pacific, and we'll be discussing everything passive investing, everything multifamily, self-storage, anything to do with building financial freedom through passive investment. The conversations, the chats are live and engaging. There's a lot of people you can network with as well as ask questions from. It's a great place to learn and have a lot of fun, so I encourage you to join us on Tuesdays. All right, let's get started. Now, let's talk about the first part of it. If we know that there's a whole bunch of uncertainty and rents are expected, we don't know what's going to happen with rents. Well, how do we accurately predict what's going to happen when we are underwriting these properties and creating pro formas? Well, with multifamily real estate, we have the ability to predict what would happen in different market scenarios. For example, we take an apartment building, 100-unit apartment building, we take its existing rent roll. That can be obtained from a T12 statement or a trailing 12 statement, and it's essentially the last 12 months operating balance sheet of the property. That'll give you a good baseline of where rents are right now. Now, we can predict what would happen if rents were to increase at 5% per year over the next 5 years during the time we were controlling this property and adding value. What would happen to the net operating income if rents remained flat? And what would happen to our profits and net operating income if rents were to decrease by 5%? By doing this, we have an ability to see what the returns would look like. We have an ability to gauge our level of risk. This is just one parameter that we can do sensitive analysis to. We can do sensitive analysis to rent increases. We can look at cap rates. Are cap rates softening up? Yes. So what would happen if we buy at a cap rate of 5 and in 2 years from now cap rates are 7%? What would happen to our profits? What would happen if cap rates remained the same? What would happen if it went down? And same thing with vacancy. So there's different levels of sensitivity analysis that can be done with any property. And very savvy sponsors will include a sensitivity analysis in their investor presentation materials. If there isn't one, don't be afraid to ask a sponsor for that. By doing the sensitivity analysis, we can come up with a realistic purchase price of what we are comfortable on offering based on these assumptions. Based on the assumptions, we can make an intelligent price point and cost basis that we can ensure profits. And this actually ties into the market cycle. If you get the numbers right, if you get the debt right, if you get your underwriting right, do your due diligence right, and you get your pro forma with great sensitivity analysis, you can invest anywhere in the real estate market cycle. You can invest in any conditions. So is there a perfect time to invest in multifamily real estate? Nobody knows for sure. But I do know that there's always deals out there. And when I talk about deals, this is a segue into that. We said that sellers have a psychological component. They don't want to sell, right? Well, guess what? Sellers that don't need to sell, they're going to say, you know what? I'm going to wait for interest rates to go down so I can get a higher price. I have no reason to sell right now. Fine. But guess what? There are always sellers that do need to sell. Example, a death in the family. A syndication, partnership, sponsorship team breaks up and they decide they need to sell the property, liquidate. A divorce, illness, somebody has to move. There's all types of personal situations of principles that occur that can expedite a sale of a property. And all of a sudden we need to sell. Or a squabbling family that inherits a property has no interest in operating this 100-unit apartment building, also we need to sell. What about and this is a big one, what we're already starting to see in today's market is syndicators that didn't have the foresight to know that interest rates were going up. And now all of a sudden they have floating rate debt that is maturing, and it matures all of a sudden, and they had it at 3% and they were making their mortgage payments and getting cash flow. All of a sudden their mortgages adjust to 6.5%, and now they don't have any more cash flow because now their debt service payment went way up. So now they have to spend more of their cash flow to cover the debt payment, resulting in decrease in cash flow, and investors stop getting their cash flow checks. And then the sponsor doesn't have enough money to continue on with their value add plan and continue renovating units. So they can't even get themselves in a position to generate more income, and they get stuck. Investors don't get their returns. It becomes a nightmare. This is going to accelerate. There's $30 to $50 billion of floating rate debt that will be maturing within the next 12 months. And similar situations to what I just described, where debt is going to readjust to double what they were paying, will create distress in the market. And all of a sudden, those sellers will need to sell. And that's pressure starts. Not only will they need to sell, but they need to sell fast. And that as a result, if there's not that many buyers out there, except for a savvy few, they pick up those deals first. Now, okay, so how about those guys that are picking up those deals? How do they battle against this interest rate shock? Well, one thing is to go with agency debt with Fannie Mae or Freddie Mac. A lot of time you can get fixed rate debt with lots of runway. You can get a 3-year loan, 5-year loan where it's fixed at a certain interest rate, and even add 2 more years of options, so you can have up to 7 years of runway of fixed rate debt. Now we know exactly what that debt service is going to be during the life of our investment. We can plan around cash flows and predictability of returns based on the debt being fixed. Having said that, we also know that interest rates aren't going to go up forever. This is a little sidebar. And this might be a good time to get into some floating rate debt with some rate caps. And with a rate cap is another way to protect yourself against rising interest rates. So you can purchase from the lender a thing called a rate cap, and that for a 1 year or a 2 year period, and you pay some money up front. In return for that rate cap, your interest rate is fixed at that percentage for up to that time period, 1 year or 2 year period, and then it'll adjust to whatever interest rates are at that time. A lot of people believe that interest rates will stop rising after Q1 or Q2 of next year. So if you were to get some floating rate debt that can adjust and get a rate cap for a 2 year period or 1 year period, and you expect interest rates to come down and adjust, and you're expecting interest rates to go down after that, floating rate might be a good play because by the time it readjusts, interest rates have come down. Whereas in a Fannie Mae or Freddie Mac, you're fixed at 5 years with expensive prepayment penalties. So you may not even be able to refinance into some cheaper debt in the future. So that's one thing to consider. But the point is that there is financing available for those buyers that are savvy enough to know that there's going to be sellers in distress. That makes sense. The other great thing that you can do if you're investing in today's market is invest with best-in-class sponsors. This becomes paramount. The last 4 years, we've had so many syndicators and sponsors entering this space that have never done a multifamily real estate deal, never done a self-storage deal, and see everybody else making money and say, me too. But now, times like this is what is going to separate the pretenders from the contenders. People that were in a rising tide where everything is going up and they make profits, and where rising tide that raises all ships, that scenario is going to be over in the upcoming years. This is going to be a different marketplace. So the ones that are excellent at operations, day-to-day operations, management of that asset, and making sure that we get all the efficiencies and get as much net income as efficiently possible, that is who's going to survive through these market downturns. People that can carry out value-add business plans or forced appreciation are the ones that can still profit during these times. You can have a forced appreciation value-add investment and be in a market where interest rates, where rent are going down and still churn a profit. So for us, Walk of Wealth, we invest only in these value-add properties where we're in control of the profits and we're not depending on the market. In fact, this forced appreciation concept is so important. That's going to be the very next video. After this video, make sure you watch the next video so you can really learn what forced appreciation is. Now, the great thing about forced appreciation is it's independent of market appreciation, right? We can generate the profit regardless of what the national market is doing. The other thing to consider when investing, even if this is a difficult time for investors in terms of uncertainty, we still have to remember that there's a tremendous lack of affordable housing in America. We have a shortage of 3.3 million housing units to support the population that we have in America today. So affordable housing remains a scarce resource. So that's what we got to remember with high demand. And then on top of that, even in a recession, there are always markets that are stagnant. There's markets that are declining. People are leaving, companies are leaving, jobs are leaving. And there's always markets that are growing or emerging where people are moving to, even during a recession. Even during global pandemics, we see migration happening. So if you position yourself in growing markets where there's lots of job growth and people are moving, combined with scarce affordable housing, that creates a natural disequilibrium, which creates an upward pressure on rents, which creates an upward pressure on net income, which does an upward pressure on market value. So my point is, even during times like this, by having the right strategies, right tactics, right mindset in place, you can come out of this recession wealthier than ever before. And then there you have it. Go against conventional wisdom. Usually when nobody else is buying, that's a sign that you should be buying. So here we can see that there will be opportunity. All right, guys, hope that helps. In this very next video, we're going to talk about forced appreciation through value add, which is what we invest in heavily. That's all we invest in is value add stuff, because we have the ability to control our own destiny. And we have the ability to control and drive our own profits. So click on the next video and I'll see you over there, and let's talk forced appreciation and how it can generate millions for us. Let's go, guys.